Welcome to the XAUUSD Institutional Market Gravity Analysis. This report has been recalibrated using more than 25,000 hourly candles to normalize higher timeframe market memory onto the H1 timeframe. Rather than relying only on conventional technical analysis, this model combines normalized moving averages, volume spread analysis, institutional market memory, and multi-timeframe confluence to identify where professional money is most likely to defend or reject price. The composite institutional score currently stands at approximately 50 out of 100, indicating a balanced market with a slight recovery bias. Gold is trading just above the H1 normalized monthly moving average 10 equilibrium between 4,097 and 4,112. While short-term H4 memory supports buyers, the daily MA20 through MA200 and weekly MA10 through MA30 remain overhead resistance. This is not yet a confirmed bullish reversal. Instead, it is a recovery attempt within a medium-term corrective trend. The most important observation is that price remains above the monthly MA10 memory, confirming that the long-term structure is still intact. However, it is still below the majority of daily and weekly memory zones, meaning institutional sellers continue to defend higher prices. Until these resistance layers are reclaimed, the recovery remains tactical rather than strategic. The monthly chart represents the primary institutional trend. Our calculations show that the actual H1 equivalent of the monthly MA10 lies around 4,097 to 4,098. Current price is trading only a few points above this equilibrium. As long as this monthly gravity zone continues to hold, the broader bull market remains technically alive. A sustained break below this area would be the first major warning that institutional support is weakening. The weekly time frame presents the strongest resistance currently facing the market. Price remains below the normalized weekly MA10, weekly MA20, and weekly MA30, which together form a major institutional resistance band between approximately 4,294 and 4,470. However, price is still trading above weekly MA50 and weekly MA100. This combination suggests a medium-term correction rather than the beginning of a long-term bear market. On the daily time frame, the first significant recovery gate is located at approximately 4,157, corresponding to the normalized daily MA20 EMA. Price has already reclaimed the daily MA10 memory, indicating improving momentum. The next challenge is the daily MA30 near 4,220. Acceptance above these levels would significantly strengthen the bullish case and indicate that institutional buyers are regaining control. Volume spread analysis provides insight into the behavior of professional money across multiple time frames. The last 10 candles on the daily and H4 charts show evidence of demand returning, with strong closes accompanied by supportive volume. The weekly time frame, however, still displays characteristics of corrective pressure and possible stopping action. On the H1 chart, volume remains balanced, suggesting that institutions are currently testing supply rather than initiating aggressive buying. Overall, the evidence favors accumulation rather than distribution, although confirmation is still required. The trading framework is entirely rules-based. Intraday traders should focus on buying pullbacks while price remains above 4,097 with risk tightly controlled below 4,034. Swing traders should wait for acceptance above 4,220 before committing to larger bullish positions. Short selling opportunities become attractive if price is rejected below 4,157 while hourly momentum weakens. Long-term position traders should only become aggressively bullish after price successfully overcomes the weekly resistance wall near 4,400. To conclude, gold is attempting to recover within a broader medium-term correction. The most important level in the market today is the monthly gravity pivot between 4,097 and 4,112. Sustained acceptance above 4,157 would strengthen the recovery, while a move above 4,220 would improve the overall swing structure. Conversely, failure below 4,034 would significantly weaken the bullish outlook. Until then, traders should respect both the opportunity presented by the monthly support and the resistance imposed by the weekly memory wall. This report is intended for educational purposes and reflects the current institutional interpretation based on normalized market memory and volume spread analysis.